Welcome! Look, if you're tired of chasing the next hot stock, only to watch it fizzle out, you've come to the right place. Today, we're going to talk about how to trade all that stress and anxiety for a calm, systematic strategy that's actually designed to build real, long-term wealth. Let's get right into it.
So let me ask you this. Does your investing feel more like you're at a casino than executing a real strategy? You know that feeling, right? That little pit in your stomach, that tension. You buy a stock, and of course, it goes down. You finally give up and sell it, and boom, it suddenly shoots up. That constant need to do something feels a lot more like gambling than it does like building wealth.
Hey, if that sounds familiar, you are definitely not alone. But it's a huge sign that your approach might be broken. The good news? It's totally fixable. There's a really straightforward way to change the game, and we're going to break it all down right now.
So what is this biggest mistake we're talking about? It's actually super simple. Most retail investors just don't stick with anything. They're constantly switching. In fact, a lot of people switch their stocks way more often than professional fund managers do, always chasing the newest, hottest story in the headlines.
There's a name for this. It's called the penguin problem. You see a hot sector, so you jump on it. The next month, some other theme gets popular, and you jump again. But think about it. If every single year you're just buying the flavor of the year, you're not really an investor, you're a trend chaser. And that almost guarantees you're showing up late to the party, basically just providing an exit for the smarter money that got in early.
Now let's dig into why this penguin behavior is so destructive. It isn't just about the constant churn. It's about what you end up buying. When you chase trends, you almost always fall headfirst into what we can call the stupid valuation trap.
And here it is. Here is the brightest red line for a stupid valuation. A price to earnings, or PE ratio, over 100. Let that sink in. That means you're paying more than 100 times what the company makes in profit in a year for just one share. At that point, you're not being optimistic. You're literally paying for a perfect fairy tale future that almost never actually happens. You're playing with pure greed, not logic.
So this really brings us to two completely different types of investors. You've got the trend chaser who buys into all the hype, paying over 100 times earnings for a fantastic story. But what happens if that company's growth slows down just a tiny bit? Say it goes from an expected 30% to a still amazing 27%. The story breaks, and the stock can absolutely crash. The disciplined investor, on the other hand, just sidesteps that whole drama by buying good companies at reasonable prices. They protect their capital from that inevitable hype cycle.
Okay, enough about the problem. Let's dive into the solution. And it's a simple, but believe me, incredibly powerful rule that forces discipline. It's going to make your investing feel, well, kind of boring. And you're about to see why boring is exactly where you make the real money.
Now this right here is a total game changer because it completely reframes how you think about time. The rule is this: when you buy a stock, you have to commit, mentally, to not touching it for 3 full years. Year 1, that's just market noise. Up, down, sideways. You ignore it. Year 2, things get a little clearer. You start to see the real business trends emerge. But it's only at the end of year 3 that you sit down for the exam and actually judge the result. This 3-year commitment forces you to accept a really crucial truth. Drawdowns are not a sign that you failed. They're a mandatory part of the journey. Seriously, think of them as the tuition fee you have to pay to Market University to earn those long-term returns you're after.
Okay, so if you're committing to hold a stock for 3 years, the next question is pretty obvious, right? How in the world do you find the right companies to begin with? You can't just pick names out of a hat. You need a system. You need a filter.
The whole process works kind of like a funnel. You start with this huge universe of over 5,000 companies. Then you apply a really strict set of non-negotiable quantitative filters. After that, you manually weed out some problematic sectors. And just like that, you've taken the entire market and narrowed it down to a manageable, pre-vetted buy list of about 50 high-quality companies. And here are those all-important filters. We want companies with a return on equity over 15%. That just means they're really efficient at turning our investment into actual profits. They have to be safe, with a debt-to-equity ratio under 1, so we know they're not drowning in loans. Obviously, they have to be growing their sales and profits. And crucially, their PE ratio has to be under 40. This is your shield. This is your defense against falling into that stupid valuation trap. All right, let's move on to execution. Once you have your buy list, you can't just sprinkle your money around and hope for the best. You need a disciplined way to buy and
just as important, a crystal clear system for when to sell.
This is what we call the sniper method. So instead of putting a little bit of money into 5 different stocks at once, you pick the single best valued company on your list and you focus all your available cash on it. You only buy that one stock until you filled its target allocation, let's say 7% of your whole portfolio. And only then do you unlock the next stock on your list. This builds high conviction positions and stops you from making scattered emotional decisions.
The million-dollar question. This is easily the hardest part of investing for most people. And if you don't have a clear framework, your decision to sell is going to be driven by fear when the price is dropping or by greed when it's skyrocketing. And trust me, both of those are a recipe for disaster.
But this right here, this matrix, it takes all the emotion out of it. It's beautiful. You only need to ask 2 simple questions. How are the business's results, and what is the valuation doing? So, if the business is doing great and the valuation is stable, you just hold. Let compounding do its magic. If the business is great, but the valuation goes absolutely crazy, say the PE goes from 30 to 120, you sell half. If the business is fine, but the stock price falls for some reason, that's your opportunity to buy more. And finally, if the results themselves turn bad, well, the investment idea is broken. You exit. That's it. Simple.
So the key takeaway here is this. You can never, ever fall in love with your stock story. That euphoria scenario is the ultimate test. Even if it feels like the greatest company in the world, if the market slaps an idiotic valuation on it, your job isn't to believe the hype. Your job is to take the profit. Okay, let's bring all these pieces together. What we've built here is a complete system. We have a way to find stocks, a rule for holding them, a method for buying them, and a matrix for selling them. This is your blueprint for building wealth calmly and systematically. And this is a simple way to structure that portfolio to build in some safety. By spreading your bets across stable large caps, growing mid caps, and high potential small caps, you create this natural balance. Different parts of your portfolio will do well at different times, which gives you stability no matter what the market is doing.
When you boil it all down, it comes back to one core message. The more you make your investment process systematic, rules-based, and, well, boring, the better your results are going to be. Successful investing isn't about the thrill of the chase, it's about discipline. If you want excitement, go to a casino. If you want to build wealth, you let the boring compounders do all the heavy lifting for you.
So, the last question is for you. Are you ready to stop being a penguin, constantly jumping from one melting iceberg to the next? Are you ready to instead adopt the focus, the discipline, and the patience of a sniper? The choice is yours, but only one of those paths is really designed to lead to long-term wealth.